First week of March, spring break right around the corner. We're watching three things, basically. There's a lot of question marks in the market right now. Let's take a look at what we're watching. Inflation. Let's talk about this real quick. Cost of everything is up. Cost of cars is up. Gas is up. Bullets, if you're a shooter, are up. Food. Everything is more expensive now, except for one thing. What is not more expensive as a class is the cost of money. All right. Mortgages are cheaper today than they were in 1983. It's crazy. For the last many years, mortgages have been going down in cost, which is why we're seeing so much activity in the real estate market. People are buying the mortgage payment, your monthly payment, more than they're buying the price. So that's why we're seeing so much activity in the real estate market. Money is cheap. And that's been kind of a hidden thing, an overlooked thing until now. And the reason why? The Fed. The Fed is stepping in. We've got inflation coming at us hard. In the way you fight inflation, or at least the Fed does, is they raise the cost of money. All right? If money costs more, people borrow less, and there's less money in the system because there's less demand with people out buying. That's what the Fed's doing. They're saying they're going to raise their rates. It's up, I think, at 1 whole point over last year. They're expecting it to go up again this year. How that is going to impact demand for real estate here at the beach? Probably be some. All right. If the cost of money goes up and the cost of the property goes up, it's going to make it harder for buyers to buy. So we're watching that. Watch that too. The next thing, Ukraine. We've all seen Ukraine, right? Russia's going into Ukraine. What a thing. What a thing. How's it going to impact us here? If it impacts the world economy and what things are happening going on, it will have to impact us to some degree. And as sad as it is, it'll probably impact us in maybe a good way. Because again, it's going to draw people to the beach as opposed to going on trips outside of the country. If there's conflict somewhere, do you really want to be in Europe? Maybe not. Maybe not. So throw the kids in the car, drive to the beach. We're going to have vacation at the beach. Let's come to the beach. So I don't know. Is Ukraine going to be a problem? Probably. It's going to have an impact to some degree. Not sure what, but we'll watch it. The third thing that we're watching, a big, big issue, is COVID. Is COVID still a thing, right? It looks like they're getting rid of mask mandates across the board. Schools are starting to remove it. State of the Union tonight. They're not going to have masks. So COVID, is it over? If it's over, does that mean people are going to start going back to work in offices in the city? Maybe. Are they going to continue to buy in Florida and commute electronically via Zoom or whatever? Or are businesses going to require folks to come back to the office? Schools, are you going to be able to go to school here, even though your school's in Tennessee? I don't know. You might have to go back to in-person schools if you're in college. All those things can impact the real estate values here at the beach. So yeah, we're going to have to watch that. What happens here? Hard to say. But you know what? Here's what we tell you all the time, right? If you're in it for the short haul, 5 years or less, sell today. We know what's going on today. We know the price. We know demand. We know all that stuff. Sell today, mitigate your risk if you're 5 years or less. 5 years or longer, sit back, enjoy the show. You got time to ride out any crazy turns in the market? No worries there. So if you're thinking of selling in the next 5 years or less, give the folks over at Keller Williams Realty's at the beach team a call. They'll be happy to tell you where your values are. And then if it makes sense to sell, if it achieves your goals, your financial goals, they'll help you out with that. Okay, so that's what's going on in our market. Here's something else that's really special today. We have Leslie Pappas, an Amazon bestselling author of Cashing In Tax-Free. She's going to talk to us about 1031 exchanges and DSTs, Delaware Statutory Trusts, and the benefits and the relief that they can bring folks that may be looking for an alternative to selling and buying another property here at the beach.
This is the Smart Beach Investor Podcast, where we explore how investors leverage real estate at the beach to live big lives and build their personal wealth. If you are an investor at the beach or you want to be, you found the right place. Enjoy today's show and be sure to subscribe to the podcast so you never miss an episode of the Smart Beach Investor.
We got a great guest today. This is going to be really, really good for anyone and everyone who owns vacation rental properties here at the beach or is thinking of maybe buying a property here at the beach. Today, we have Leslie Pappas, who is the owner and founder of Archer Investors and the author of a Amazon best-selling book, Cashing In Tax-Free. Leslie, how are you today?
I'm great. How are you?
I'm doing great, Leslie. Thanks a lot
Super.
for being here. Hey, Leslie, tell folks who you are and what you are and what your background is real quick.
Sure. Well, thanks for having me here today. I really appreciate it. So I'm 64 years old. I've been in financial services since I was 24. So that's a good long time. And I came to real estate specifically in 2000.
Okay.
And focused on rental properties and actually listing them as a real estate broker. But quickly learned about 1031 exchange, which is a method we can use to avoid paying capital gains taxes when we sell a rental property.
That's right.
And then I learned about the syndicated real estate industry, which is what I do today. I don't practice
so that's
as
a little bit more esoteric. Is that true? I mean, I don't know that a lot of folks understand the syndicated aspect of it. Syndication.
Well, I'm here to describe it.
Nice.
So
okay.
Basically, what is syndicated real estate? It is a situation in which we bring together people who don't know each other to purchase a property of a scale that none of them could ever afford alone.
Okay, so it's a big ticket item.
Right. It's 50 million and up.
Wow. Okay, so 50 million is a floor. It can't be 49. It has to be at least 50.
Oh, no. It can be 59. I'm just talking in generalities.
Okay.
It's called an institutional grade of real estate.
Okay.
Institutional real estate is the same kind of real estate that big players own and trade in.
Okay.
Pension funds, banks, insurance companies, foundations, all these different big players are the folks that we compete with to buy these properties. And they're also the people we eventually sell them to when these properties liquidate. So now we're graduating up to owning institutional grade real estate as a fractional owner of the property.
So is that like a stock or something, or how does that work?
Well, it's not like a stock, although it is a security. So that's a little confusing. You might be familiar with real estate investment trusts, REITs.
Yep.
Those are also securities. A security involves bringing people together to own the property in a group. Whenever you have a group participating, it becomes a security.
Okay.
And there are other rules, and this is really pretty detailed stuff for the call. But the good thing about this is it's regulated by the Securities and Exchange Commission, and in fact, it's very heavily regulated for consumer protection. So we spend a great deal of time making sure that we're making all the right disclosures to our clients. And making sure they're fully aware of what they're doing, what the point is, what the investment is, what the outcome should be. And this has got to do with good client service, certainly, but it's also got to do with regulation.
Sure.
These are our requirements. So that's for investor protection, and it's very important.
Okay, I'm with you on there. And these are Is this a syndicate that you have control over, or how does that work?
No. What I am is an investment advisor in the field of real estate. Okay. So a client comes to me, say they're selling a duplex or a fourplex or a condo that they rent to VRBO or whatever.
Sure.
They come to me and they say, Leslie, I want relief from capital gains taxes.
Yeah.
I want to perform a 1031 exchange, but I don't want to own, rental property anymore. I'm tired of managing it.
Okay.
So they have the ability now to invest in these syndicated investments, which are called Delaware Statutory Trusts, DSTs.
Okay.
And my job is to vet the players in the field who are called sponsors. These are the people who bring an offering to us for consideration.
Okay.
So we vet the sponsors and we vet each individual offering for its merits.
Okay.
Relative to risk and potential return.
So let me ask you, how many offerings are these coming rolling down the road every day, every week, or what are we
They
talking about?
do. They
Okay,
change all the time.
nice.
At any one time, I probably have 35 offerings available for our due diligence.
Okay,
Of the 35, we might like 20,
okay,
and that's as a firm. And of the 20, I might personally be behind 7, 8, 9 of them.
okay. So let me
And what
just,
I do is I rank these properties against each other, number one, number two, number three,
okay,
in terms of their risk profile and their potential profit for my
nice,
clients.
nice.
And my job is to get my clients diversified. So if a client comes to me with a $500,000, we're going to move into 2 or 3 different Delaware statutory trusts, just like you wouldn't buy one stock, you'd buy 5 stocks.
All right. So you're going to take that 500,000 and you're going to split it between a number of DSTs.
Proper. Exactly.
Interesting.
And the client is now going to enjoy diversification
Yep.
geographically, diversification by the firm that's representing the offering, the sponsor, and also diversification by what kind of property they're going into. It could be a 400-unit multifamily property. It could be a medical office. It could be a portfolio of self-storage properties. It could be a portfolio of Walgreens.
Love it.
It could be many different kinds of properties. Generally, as a rule, and given all I learned, I've been doing this for 20 years since the Great Recession.
Mm-hmm.
I stay away from office. I stay away from hotel. I stay away from senior assisted living.
Why is
These
that?
categories, the categories are far too risky for my clientele. And in each case, even student housing, in each case, these types of properties depend upon an operator. So if you have a hotel, it has to be managed by somebody.
Yeah. Okay.
How good is the manager?
Yeah.
Just because Marriott's behind the property doesn't mean that the team that's in the property is going to be doing a great job.
Sure.
So whenever we go into an assisted living, a hotel, this kind of thing, we're depending on an operator, and it adds another level of risk, another
Yes.
layer of risk, I
Yep.
should say,
Mm-hmm.
that, can cause things to blow up.
So
And
you're
in the
going
Great
into,
Recession, we saw these properties fail.
yeah, for
So,
sure. So you're going into a
yeah.
class of property that doesn't have a middle management requirement?
Well, no, there's always a manager.
Okay.
And the managers that we employ are, national class property managers,
Okay.
companies like Greystar,
Okay.
Bell Partners, and Carroll, and, very big companies managing hundreds of thousands
It's
of
what they
units.
do. Okay.
It's what they do.
Okay.
So, it's, I have to say, it's very well controlled who is managing these properties. And not only do we have a property manager, we have an asset manager for each offering, for each property. The asset manager's job is to work on the behalf of the investors to manage the property as if he or she owned it themselves.
Nice.
To
Okay.
manage the property manager, to watch the daily, weekly, monthly, quarterly numbers, to visit the property every quarter, and to eventually decide when should this property be sold.
Interesting.
Yeah,
Okay.
so these DSTs have a lifespan. We're coming into that. And, they on average in the past have had a lifespan of 6 to 8 years. You buy into it, and on average in the past, they would resell in 6 to 8 years.
So what does that
That's
look
a
like?
liquidity event.
What does that look like?
Yeah.
If I property here, say I own a condo, I sell the condo, I got a capital
Yeah.
gain that's coming at me. I contact you, or I contact you, or whoever has the capital gain, and you have a series of interviews or whatever to figure whatever's are their taste or whatever their appetite for risk or whatever it
Their
may be.
needs, their
Okay.
goals.
Yeah, there you go. And then you're going to place their monies as you see fit to match up. And then what?
Yes.
They sell it in 6 or 8 years, or are they getting dividend or something, or some passive throw
Well,
off in the meantime?
they're getting cash flow on a monthly basis.
Nice. Okay.
They get the cash flow. They get all the appreciation. They may well have a brand new depreciation schedule that's going to protect their cash flow from income taxes. These
And this is
properties
mailbox money because they're doing nothing, right?
Oh yeah, absolutely. It's all mailbox money, comes through direct deposit to the checking or savings every month, usually around the middle of the month.
Yeah, that's a
But
win.
it's important to note that, in the down the road in 7 years, say the property has appreciated by 50%.
Okay.
That's all the investor's money. So they're going to come out in that case, if they put 100,000 in, they're going to come out with 150.
Nice.
Plus, they would have enjoyed all the cash flow.
In the meantime.
Plus all the tax benefits.
That's why you do it, right? And then what? You roll it into a new DST, or do you go back and buy some piece of real estate, or just cash out?
Most people roll it into a new DST. I have to tell you, when I work with a client and we get them closed in their own portfolio of DSTs, what they feel is relief. The money's coming in to their checking account, and they don't have to do anything to get it.
Yeah, there's no property manager.
They're very often making higher cash flow than they were previously.
Nice. No property manager. They don't have to do any upgrades or updates to the property. There's never any pressure on that. It's just sit back and relax.
Right, exactly. So there's something important that we haven't talked about that I want to talk about. I did mention this is a heavily regulated industry.
Okay.
And one of the things that's regulated is who may invest.
All right.
One has to be called accredited investor, an accredited investor in order to invest. And what does that mean?
Okay.
That means you have a net worth over $1 million, not including the home you live in, the equity in that home. Or it can mean you have a substantial income. It's an either or thing. So you either have to have a net worth over $1 million, not including your personal residence, or you have to have a substantial income. As a single person, $200,000 for the last 2 years with the expectation of it carrying forward. So an accredited investor, this is about 8.5% of the population in the United States.
Okay.
So, that's important for your clients to know.
For sure.
Because if we're not accredited, we can't do this.
Okay. But if they are, they can absolutely and probably should, especially now when we have such a tight inventory of properties for them to buy. One of the problems are they're looking at the inventory and not seeing where, if they sell, where would I roll it into? Well, Leslie's got plenty of options for you.
I've got lots of options. And you also have that 45-day identification deadline breathing down your neck in the 1031 exchange. For me, say one of your clients decided to sell their condo that they rent through VRBO or whatever. Right. They would have come to me, and before they even closed on the sale of the condo, we would be picking the properties they would invest in.
Yeah, right.
And we on average have our clients fully reinvested within 2 weeks of the sale closing on the relinquished property.
Okay, so does it go through the intermediary then in the same avenues?
Yes.
Okay.
Yes. And we have an intermediary that we have negotiated preferred pricing for our clients.
Okay, makes it
easy. And they are the biggest intermediary in the country. They're called Investment Property Exchange, IPX1031.com.
Perfect.
So it's just a flat fee of $1,000, no extra fees in that negotiated price for Archer clients.
Nice. So let me ask you, Leslie, these DSTs, is there an average throw off that they do in terms of cash flow, or what could somebody expect?
Yeah, the cash flows today are ranging from about 3.5% per year for multifamily.
Okay.
To about 6% per year for industrial triple net portfolios like a Walgreens portfolio. Yep. Anything with a long-term lease like industrial or triple net, can be in the mid fives up to 6. Now, one of the things I teach my clients about is the effect of depreciation allowance on their cash flow.
Yeah.
And so, it really is very beneficial to be invested in residential real estate because we're on a 27.5-year depreciation schedule instead of 39 years for all the other categories, retail, office, industrial.
Can you do cost segregations inside a DST? Do they do that? Is that a thing?
You can. Yes, they do sometimes. They don't always, but they do sometimes.
Okay.
And that's very beneficial.
Yeah.
The idea here is to create we have created a product that suits people who are in or near retirement, who want cash flow, want to be able to depend on their cash flow, don't want the hassles of management, maybe want some more safety in their portfolio. A lot of people own, 5, 10 properties all in the same town.
Right.
That's really risky
Yeah.
because the
And
tornado
just
can come through. Anything could happen.
right. And even if you're not getting towards retirement age, even if you're younger, but you just want to diversify a little bit, and you can stay in
Yep.
the vacation rental market for sure. But you don't have
Right.
to. You can take some cards off the table, so to speak, and put it into a DST and just kind of enjoy that mailbox money.
Exactly.
I like
Exactly.
that.
And we have a myriad of investments available for cash investment, a whole bunch of different things, funds and real estate investment trusts, that kind of thing. Today, we're talking mostly about 1031
Yeah.
exchange money.
Yeah. Okay. And are we worried about inflation? Is that a thing?
Yes. Yeah.
Okay.
I'm very worried about inflation. And for that reason, I'm sort of guiding my clients toward any investment where we can change rents quickly. And that
Okay.
would be multifamily and self-storage,
Okay.
those two categories. So
Love
we
that.
really don't want to be tied into big long-term 15, 20-year leases.
Right. Right.
And, because those leases are only going to be paying 5.5%,
Yeah, and you're
6%.
locked
Well,
in.
what if,
Yeah.
what if inflation goes up? What if interest rates go
Stay away from the long-term leases right now, for sure. For sure.
right?
I heard
We're
somebody
losing
say,
money every day.
don't even get into an annual lease. Go 6 months because you don't know. It's jumping so fast. But I don't know if you can do
It
that on a
is.
commercial standpoint. But wow. Wow. So here, what I hear happening here, Leslie, is when these owners here, these properties at the beach, these condos, these houses that they're renting out. And right now we are at a high point in the value world. So if they want to get out, if they want to take some of these properties off the table, cash out, they can do a 1031, avoid the capital gains issues, roll it into a DST, retain that passive income with even less involvement. How long do they have to stay in it then? They last 6 to 10 years, you said, or something? How is there a
Yeah, it's
minimum?
going to be, no, it's a liquid. So the idea is you
Oh.
can't really get out of it once you're in it.
Okay.
This is one of the negatives.
Okay.
And, when I'm on the phone with a client, I always make a point of talking about the negatives. Illiquidity is the negative.
Okay.
If you own a house that you're renting, you can put it on the market and be liquid in 90 days,
Right.
maybe earlier.
Right.
There is a very small resale market for DSTs, very small.
Right.
And the seller of a DST in that small market is always going to come out with less than they put into the investment,
Okay.
because people don't even try and sell DSTs. Advisors are doing a good job of letting people know ahead of time that this is illiquid. There's no market to resell it.
But that's all
You're
right.
in it for the long haul.
That's
You're
all right.
in it for the long haul.
So tell me real quick then, Leslie, what happens if I die or
Yeah.
get killed in a tragic accident? What happens
It's
then?
just like the single family house you rent. It's exactly the same situation. Now, hopefully most of your clients have living trusts
Yep.
that make that transition so much easier
Yeah.
for the heirs.
Yeah.
Hopefully we don't have to go to probate and all that stuff, because it takes a long time and it's very expensive.
Yeah. Estate planning is important. And this is part
Estate
of that.
planning is really important. And, the idea here is that the heirs will inherit at a stepped up basis for
Perfect.
the DST, just like they would any other kind of property. It's exactly the same.
So if I'm a little
And-
bit older and I own this property and I've owned it for 30 years here at the beach, my kids don't even come anymore, or we just don't use it like we used to. I'm kind of getting to the end of the run, but I don't want the tax issue. I could roll this into a 1031 DST and put it into my trust, and I'm done. I'm out. I still get
Yeah.
the passive income. My kids will get it in the future, and then they can do whatever they want. Or
Right.
This sounds
Right.
like a perfect
And
situation.
if a family has a living trust, that condo on the beach should already be in it.
It should be in it for sure.
Yeah, should be in it. And in terms of estate planning, since you mentioned the word, the idea is to swap until you drop.
Swap until you drop. That's right.
Keep 1031 exchanging, keep it up, never pay the taxes.
Yeah, because you can take
Um,
that money out of your property here right now if you want to sell. Recognize it's a high point in the market, but doesn't mean you have to get out altogether. You just put it in a DST. You collect your money, put it in the DST, and now you're getting passive income there, and it just keeps rolling.
yeah, and the other thing to keep in mind, it's very important that a client can do a partial 1031 exchange.
There we go. What's that look like?
Say they came out of their transaction with $500,000 in cash.
Okay.
They can take $100,000 and put it in their pockets. They can touch that money and exchange the remainder.
Look at
Any
that.
money they touch gets taxed.
Okay.
So sometimes, they want to take a cruise, they want to
Right.
build a deck on the back of the house, whatever it is. The grandkids are going to college.
Yeah.
A family will take some cash. It's called boot,
Yeah.
BOOT. They'll take some cash to
Right.
help in this funding, whatever the need is, and the remainder of the funds will go through the 1031 exchange in a partial exchange.
Love it. And you guys do all that, or your intermediary or whomever. Is that?
Yeah, they do. Yeah, we do all that stuff, and we talk about it all right up front.
Love it.
It's important to know before you close on the property you're selling that you want to take some boot because you want to get it out of that escrow. You don't want to transfer it to the exchange accommodator.
Okay. That makes sense. That makes sense. All right. So let me ask you this, Leslie. It seems like everybody knows what a 1031 exchange is. DSTs are a little bit more in the back corner. Why doesn't everybody know about this?
We're not allowed to advertise.
Not allowed to advertise.
The reason
That's
we're
interesting.
not allowed to advertise, and it's for consumer protection. It's because the investor must be accredited.
All right.
So if we go start doing mass advertising out on the airwaves, we don't know who's calling us. We have to qualify them. We have to say, are you an accredited investor? Here's what that means. Do you qualify? And then later on, we have to prove that they're accredited by doing a financial statement with them.
Okay.
So we are not allowed to advertise, and that's why it's not well known. Now, you mentioned I wrote a book.
Yeah.
The reason I wrote the book is because nobody knows what I'm talking about. The CPAs don't know what I'm talking
They
about.
don't.
The
I know because I
realtors
have
don't know
one.
what I'm talking about.
They don't know what the heck I'm talking about.
Right.
So
And it's difficult that way. But
so
the
we're going to
book
help
makes
them know what
everything
we're
very
talking about, aren't we?
exactly. The book is a nice, easy to read introduction to 1031 exchange and DSTs.
Okay. So let me ask you, cashing in tax free, how are they going to get a hold of this book? Amazon? Where are they getting this?
Oh, it's for sale on Amazon.
Okay.
Your clients can also just call me, have a conversation, and I will send it to them for free.
Love it. So Leslie, how does somebody get a hold of you? They're thinking about selling. They're not really sure. This has spiked their interest a little bit. How do they get a hold of you?
Well, there's a few different ways. We have a website, archerinvestors.com.
Okay.
Investors, investors.com. And there's a place you can click there to send an inquiry for a 15 to 30-minute appointment.
Okay.
That would be with me, most likely.
Okay.
The phone number's there. You can call the phone number. You come right to my cell phone.
Perfect. And we'll have
myself,
that it's on the screen here as well. And we'll put it in our show notes for sure. We'll get it to you.
Super.
Nice.
So just put a call in. Learning a little bit about this really takes about 15 minutes. It's not a big commitment.
Okay. And does timing matter? I mean, if they do it next week, next month, next quarter, does it matter? Is there a time of year does it matter?
Nope, doesn't matter.
So they should start now, check it out, see what they're comfortable with. If this is a thing, go for it. If it's not, keep going the way you are, right?
Right. And, we provide our clients with a lot of information. I mean, when I founded this company way back in the 2000s, educating the investor was my first goal.
Yeah.
And so that led to the book. But, we do a lot of webinars.
Yeah.
We do short ones. We do long ones. We want the investor to have a lot of exposure to different offerings, different kinds of offerings,
For sure.
and directly to the sponsors, who are the people who are going to manage this property on behalf of the investor. So there's a lot of outreach that happens through email, through webinars, through the book, etc.
Because I can see a ton of our client base that would fall into this, and this could be a nice little escape hatch for a lot of them into something.
Yep.
Really good for them. Cool. Cool.
And then they too can have that feeling of relief.
Yes, that's exactly what it is. Relief, just mailbox money coming. They don't have to manage anything. Perfect. Leslie, this has been terrific. This is so good. I'm really excited for you to come on here and explain this a little bit.
Well, thank you for the opportunity. I
Sure,
appreciate it.
sure. We're going to help our folks be smart beach investors. That's what we're trying to do. That was some really good information about DSTs, Delaware Statutory Trust, 1031 exchanges. What a great way to get out if you're at the end of your investment run here at the beach. Check out the show notes for Leslie's contact information and give her a shout. See what she has to say. This might be the perfect thing for you.